EOS Why Crypto Volume 4. Yet another month has gone by in the world of cryptocurrency, and if you are anything like me, you've been watching the Bitcoin chart carefully to see whether it will hold its current trading channel, or will it plummet down to define a new current market low. Of course, what happens in the world of cryptocurrency does not happen in a bubble, and a lot will depend on whether the Fed continues its current market policy of raising interest rates, or will they finally pivot, which will signal the all clear for the stock and crypto markets. And with that being said, that leads me into this month's topic for today's video. In this video we'll be going over an article I read called Fed Raises Key Interest Rate by 3/4 of a Point, and I will be giving you my opinion on what I think about the topic. Links to the original article will be below. Okay, now let's get started.
Disclaimer: crypto investments are highly speculative and involve significant risk of loss. Past performance is not necessarily indicative of future results. Always do your own research and invest wisely.
To summarize and paraphrase, the article first begins with, Wednesday was the third time in a row that the Federal Reserve raised its main interest rate by 0.75%. This was done to fight high inflation and raise the chance of a recession. The Fed raised its target short-term rate from 3% to 3.25%, the highest level since early 2008. Officials expect to hike its benchmark rate to 4.4% by year's end, a full percentage point higher than they predicted in June. Next year, they plan to raise it to 4.6%, the highest since 2007. The central bank acted Wednesday after a government study revealed rising prices across the economy. The Fed raises interest rates, making mortgages, vehicles, and business loans more expensive. Consumers and corporations borrow and spend less, cooling the economy and reducing inflation. Fed Chair Jerome Powell said policymakers want to be extremely convinced inflation is falling to their 2% objective. The employment market's resilience is driving pay rises and inflation, he said. Fed officials want to limit growth enough to tame inflation but not enough to spark a recession. Most economists believe the Fed's rate hikes will lead to job cuts, increased unemployment, and a recession this year or next. No one knows if this process will cause a recession or how severe it will be, Powell added. How swiftly we reduce inflation will determine that. Fed policymakers expect poor economic growth and growing unemployment in their latest estimates. It forecasts unemployment to reach 4.4% by 2023, up from 3.7% now. Economists say a recession always follows a half-point spike in unemployment over several months. Fed officials now expect 0.2% growth this year, down from 1.7% 3 months ago. From 2023 to 2025, it predicts growth of less than 2%. Even with significant rate hikes, the Fed predicts core inflation will be 3.1% at the end of next year, considerably above its 2% objective. Last month, Powell said the Fed's measures would hurt individuals and companies. He noted that the central bank's goal of lowering inflation to 2% was unconditional. Falling gas prices have somewhat cut headline inflation, which was 8.3% in August. Declining gas prices may have boosted President Joe Biden's approval ratings, which Democrats hope will help them in the November midterms. Short-term rates at the Fed's target level would raise mortgage, vehicle, and business loan costs, making a recession more likely next year. Rates haven't been this high since before the 2008 financial crisis. The average fixed mortgage rate hit 6% last week, a 14-year high. Bankrate.com says credit card borrowing prices are at their highest since 1996. Inflation is currently being generated more by higher earnings and consumer spending than by supply constraints during the crisis. On Sunday's episode of 60 Minutes on CBS, Biden said that the economy could still have a soft landing and that his administration's recent energy and healthcare bills would lower the prices of drugs and healthcare. Some economists worry that the Fed's rapid rate hikes, the fastest since the 1980s, will cause more economic harm than is required to manage inflation. Mike Conchow, a Roosevelt Institute economist, said that the economy is already slowing and that wage growth, a crucial driver of inflation, is leveling off and, in some cases, dropping. According to surveys, Americans expect inflation to decline in the next 5 years. This is crucial because inflation expectations can become self-fulfilling. If individuals expect inflation to ease, they may buy less. Less spending would slow price growth. Conchal said the Fed should slow rate hikes at its next 2 meetings. Given the imminent cooling, he advised, don't hurry into this. The Fed's rate hikes parallel those of other major central banks, contributing to global recession fears. Last week, the ECB boosted its base rate by 0.75%. The BOE, RBA, and BOC all raised rates in recent weeks. Repeated pandemic lockdowns are hurting China's growth, the world's second-largest economy. A global recession might destabilize the U.S. economy. Even though the Fed is raising rates more quickly, some economists and Fed officials say that this hasn't stopped people from borrowing and spending or slowed down GDP. Many economists believe layoffs are needed to limit price growth. Research from the Brookings Institution that came out this month said that unemployment may have to reach 7.5% to get inflation back to the Fed's goal of 2%. Just my opinion. Is anyone here besides myself getting the feeling that the Fed is simply being less than honest? I understand the desire to supposedly get inflation under control, but when you factor in the supply side of the economy, most of the higher prices are coming from supply shortages. Furthermore, there is a significant risk of the bullwhip effect, which can create oversupply in some areas of the economy, which could create a significant deflationary effect. Stagflation seems to be the issue of the day more than inflation, and as a result, it seems the Fed is purposely trying to drive us toward a market crash, which will likely usher in a recession. This is just my opinion, but I have no faith in their ability to properly control the chaos they are about to wrought. Which is why I advocate holding crypto, especially undervalued programmable cryptocurrencies like EOS. Either way, time will tell the story, whether the Fed will be able to masterfully control the descent of the market, or will we soon be undergoing another 2008 market crash.
Thank you very much for watching. If you enjoyed, give us a thumbs up and subscribe. Also, if you would like to read, listen to, or watch more of this kind of content, please visit us at www.cryptoapologetics.com. See you next time. Take care.